It's through the day and the rest of the week. Let's kick off this morning here in Dubai with our regular commentator, Paul Young, Head of Energy Products at Dubai Mercantile Exchange. Paul, good morning. Markets are opening again, I'd say a little higher, but essentially little change might be the right way to put it.
Yeah.
What's your outlook and thoughts on this market Tuesday morning?
Yeah, hi Sean. Morning, everybody. Leading the headline is Chinese import data for crude up 21% year on year. Not really a fair comparison because March last year was the height of the pandemic for China. So if you're trading on that figure, you might want to look at the underlying details again. I mean, the real figure is that China is still fine on imports. It's pretty much flat Feb to March at 11.7 million barrels a day, not the heady levels of 13 million barrels a day during Q3 last year when the price, taking advantage of the lower prices. But I mean, it looks reasonable in Asia. The other bullish figure for this week was India data. We've had a few of your commentators talk about the grumbles from India of high oil prices and what's going on there, and we saw diesel and gasoline demand up 10% or so. Overall price trend, I was just looking, last time I was on, a month or so ago, middle of last month, we were $65, $70. A lot of talk then was 70. The last 3 weeks, we've gone into that narrow range again, just on a DME or man 61 at 63.50 trading range for 3 weeks. It sort of feels a little bit like Q3 of last year, where didn't really know where it was going, but that flat trend lasted for 3 months. I'm not sure we'll get that this time around.
Let's welcome Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, the story that we have there's 2 stories from India in the digest today, and they kind of more or less sum up the current challenge. India gasoline usage is jumping to levels 4-month highs in March because commuters are preferring cars than public transport. And yet at the same token, India is suffering record new COVID infection rates. The market's confused.
Absolutely, and rightfully so, because we're trying to combine 2 things. A current pandemic, which is still causing havoc and not yet under control, and the market just trying to look ahead into the second half and that growth sprint that is already underway, but obviously it's expected to accelerate further as the economies opens up further. So trying to combine these 2, the short-term challenges with the slightly longer-term positives and tailwinds. That's really what I think is creating this current situation. But overall, I think we've seen a lot of the speculative froth come out of the market now for the past couple of months. That's quite supportive for a new push when and if fundamentals will justify that. But and in the meantime, just as Paul said, we're stuck in a range. So I look at Brent obviously mostly, and we're looking at a $60-$65 range, near the high end of that today, but again, we're still really looking for a trigger. I think for the day ahead, I'll be looking at the OPEC's oil market report, which should be out in a few hours' time. Just basically seeing the latest, obviously following the latest meeting to where they agreed to increase production slowly over the next few months, but also obviously their latest gauge on the outlook for global demand over the coming months.
Peter McGuire, CEO of XM Australia. Peter, everything in China looks like it's still on track for a very bullish outlook. China oil imports, crude oil imports into China jumped 21% in March, as mentioned by Paul. Why would that not be giving some uplift to oil, particularly when we're seeing on the risk asset size equities, Bitcoin still breaking records every few days?
Well, good morning, Sean. Good morning, other panelists. Yeah, I think a little bit of demand destruction, Sean. Have a look where we are, building on what Paul and Ollie said, there's very, very range bound, and the smart money certainly isn't making much of a dollar if you're trying to be long or short. If you're taking option strategies, that might be a different appetite. But quite simply, there's no clear breakouts either side until you really get a little bit more push, and the push has got to be probably later in this quarter. If we get through the Brazil numbers, is what we're thinking as far as those COVID, and India, if we seem to tail them back off, then it could be a strong push up for, July, August, September for crude. But at the present, there's easier money to be made on other markets, Sean, and there's no great attraction. As far as China's concerned, yeah, there's no doubt that I think it's going to be, they'll surprise this week with numbers, and I think it's probably going to be a very, very strong quarter for them. So
do you see any downside risk, Peter, or is this just to the upside, when and how far it moves, but we're pretty much done to the downside?
Well, that US dollar I keep an eye on, Sean. It's off from that 93.2 to really 92.2. So I'm keeping an eye on that, the inflation numbers. Demand destruction is an issue that I think everyone's getting back on board because of India's COVID, and of course Brazil and America, is, the US's numbers are climbing again. So that creates more angst, and across Europe as well. So we're a long way out from absolute sunshine. I think 21, we always said it was going to be a rocky year, and that is starting to materialize.
Paul, could you give us some thoughts and insights on Brent versus Middle East spreads, what that's looking like, any indicators there?
Mm-hmm. Yeah, that's been an interesting one, Sean. If we cast our minds back to second half of last year, Brent against Oman or Brent against Dubai was relatively flat because the tightness in the market was the heavier barrels, because that was what was taken off the market as spare capacity. We've seen that what was initial creep to broaden or widening quite a bit now. So it went to 50 to $1 Brent Oman. It's now Brent Oman or Brent Dubai is in the $1.50 to $2 range. The Brent Dubai EFS is $3. It's been there a couple of times this year, but like for 1 or 2 days. So will it consolidate there? So you can say you'd expect that, as we've heard a lot on like the Gulf Intelligence webinars, the gasoline and gas oil crack, well, particularly gasoline, but gas oil to a lesser extent, cracks have improved. So you'd expect Brent to pull away a little bit, but are there fears that all this spare capacity in the Middle East is going to be unleashed at some point, whether it's like OPEC plus barrels, more Iranian barrels coming back on the market, those cracks may be staying higher? There's certainly something happening there. I was a little bit surprised because the US exports, which is obviously it is light sweet crude, competes in that either Brent or Murban space, has been unleashed again. They're way back above. I think the latest figure was nearly 3.2 million barrels a day of US exports, which should compete with North Sea crude. And we heard, I think it was Addy said yesterday, there's a lot of West African in the market. So Atlantic Basin theoretically looks long again. So why is it pulling away from Middle East? Yes, the distillate and light cracks are one part of the story, but are there fears that as we go forward, more and more of this spare capacity will find its way on the market again?
Ole, the expectations are for further crude stock draws in the US this week. S&P Global Platts coming out early in the week with a forecast of 2.9 million barrels, and essentially getting us closer and closer to that treasured 5-year average. That in itself doesn't seem to be giving lift to the market. If indeed it is reaffirmed by the EIA later in the week, do you think that becomes some kind of an upward momentum for prices that as we get closer to that 5-year average?
Probably not enough at this stage, Sean, because at the same time we're also seeing gasoline and fuel stocks on the rise as we head towards the summer demand season. So overall, I saw the EIA report yesterday. The drilling basically looking for a pickup in Permian crude oil, but at the same time, one of the reports you put out this morning basically is highlighting that the pipelines are running a bit low on supplies because we are still well below capacity that a peak that we had more than a year ago, but generally that should be positive. But the demand is still not there, and and if it hadn't been for the 2 million barrel reduction in U.S. production, then obviously we would have been in a much tougher place than we are right now. So U.S. production is likely going to slowly be on the increase, but I don't think in terms of price reaction that we're going to see much on that front. There has been some pretty incredible numbers over the past few months. Obviously, some of that due to disruptions. So I think the market's gone a little bit stale in terms of looking at this as the weekly, equivalent of U.S. Job reports in the old days. So not the same kind of reaction pattern as we've seen in the past, I would say.
Peter, in earlier days gone by, the kind of geopolitical noise that we're seeing in the region at the moment would have been supportive to oil prices. We saw overnight reports of further missiles out of Yemen towards Aramco facilities in the kingdom. We've also had the Iranians threatening Israel on retaliation for what was seen as some kind of a target, a cyber attack on the Iranian nuclear facility at Natanz. What is your sense of this? And of course, all the time the Iran talks are going on in Vienna. Is this something that the market should be paying more attention to?
Well, Sean, building on that, you would have thought that would have had some form of spike there, maybe a couple of bucks, but it just hasn't happened, and it really has no impact at the moment. I'm not to say that it won't have an impact if things build from here.
And we also have geopolitical risk in eastern Ukraine. There's a lot of noise there about potential aggression, and the rhetoric overnight is elevated.
Well, of course, and the other side is that hasn't gone away is the Taiwan/China issues. So, yeah, I really would have thought that may have been enough of an impetus to wrap a couple of bucks on it, but it just hasn't happened. It hasn't materialized, and possibly it needs to see more action from a and that's from a bad scenario, but more deliberate in the sense of the strikes and to take out maybe refinery or do something like that to really have an impact. And at the present, I would think that the world is just absorbing this. It's mindful as far as virus. It's mindful as far as OPEC and their viewpoints. And at the present, there's nothing really there from a geopolitical side to ignite friction and create a risk premium rolling into it.
Paul, the timing of the increase in OPEC plus production exports in May is landing into Asia, while Asian refiners are still in maintenance season. How do you see those two things sort of coexisting, if you like? Asian refiners saying, well, we don't want too much oil, and OPEC plus increasing into that. What are your thoughts?
Yeah, so I guess our news cycle again is increasingly dominated by OPEC meetings. We've just finished one and already looking towards the next one. Obviously, Saudi is the one that's been urging caution all along. We came under a lot of pressure to release some more barrels. It looked okay. I mean, the last meeting, we were coming out from Brent around $70. So it looked a safe decision. But maybe the market is reading it, with the timing with the maintenance season, it was a little bit too much too soon. You've got to see the demand growth first. And, it's demand creep rather than a demand surge. So everyone's going to be, still looking at these figures of vaccination rollouts, lockdowns, how real the demand is. We heard before about India. Yes, that's surging again, but that has petered out because of the cases there. So, if we want to look already, like in a couple of weeks' time, I'd be very surprised if OPEC was to release any more. I'd be surprised if they roll back. So the only option would be Saudi to say, okay, well, we'll keep our additional barrels that they were going to start putting back off the market for a while. But again, these decisions aren't taken until we literally get to the day of the OPEC meeting. It's such a fluid situation. So it'll be, day by
Well,
day.
certainly
really.
the signals from Asian refiners or others that they don't want full allocations will certainly, I suppose, tell its own story. Ole, we had the Fed chairman talking again over the last few days about his outlook. He's sort of expressing concerns or caution that we're possibly at a tipping point vis-a-vis the US economy, everybody coming out to play because of the vaccine rollout, and yet the COVID infections could surge on the back of that. That's a challenge everywhere. Perhaps America is the first in the queue.
Absolutely, and I think it also highlights one of the problems right now in the market is that we are facing a period of higher inflation over the coming months. Just a base effect of last year's slump and subsequent rally across many of these commodities, especially oil, will have an impact. And the question is really how governments, if at all, will respond to that. So the US, on the US side, it looks like they're not in any hurry to tighten, so they will allow inflation to overshoot. For still obviously looking for this to be temporary, and that's obviously the big question, the big if in the market, whether we are going to see this taper, this spike we're going to see now over the next 6 months, whether that will taper off as we head into early 2022. I think I'm a bit cautious about getting too optimistic on lower inflation again. I think there are price pressures emerging across the market space, and that
including but very high gasoline prices for the summer driving season, $3 to $4 average across America.
Absolutely, the highest potentially since 18, and maybe even further back than that if we get a new push to the upside in crude. But I think the risk, and we're seeing that, and the potential risk to commodities to demand is China, because they have indicated that we saw this very high factory cost out prices increase last week. It's been rising for several months now, and we are seeing signs that they may want to tighten liquidity, step in, try to curb the inflation from getting out of control. And if that's the case, then potentially that could have a negative impact on activity in China over the next 6 to 9 months. So that's probably one I'll be keeping a close eye on in order to really try to gauge whether this so-called super cycle, whether that is really getting some momentum here. For now, it's just at least taking a bit of a breather and a pausing.
Peter, you mentioned earlier the dollar, watching the dollar. It's been on a weakening trend for a few weeks now. Anything that you would identify that could possibly shift it back to a bullish trend?
Well, Sean, since the start of the month, we've seen a very, very strong push to the upside as far as euro. The Aussies had a nice little rally, also Kiwi dollar a little bit, and some of the other currencies against that dollar. So maybe it's just in a downdraft at the moment. I think it was at some point there, it was probably overbought when it shot through 93. So at the present, that 92.2, 92.3 handle, I think it's got the capacity to be in the 91.7s, 91.8 over the next matter of a week or two. And I think that continual softness may be where a trader needs to look at that part of the market. So
has the effort that we saw, the sort of some strengthening on the dollar or the back of the bond markets indicating higher rates cycle, is that now tension gone out of the market?
Well, I think it has to a point, after building what Ole said. The other side is, of course, that Jay Powell keeps on coming out and saying there's nothing to worry about. So that just seems to flatten it again and take all of that hot air. So that's why I'm thinking that there's possibly a further push to the downside over the next week or week and a half, that continual downdraft. And from a trading perspective, just taking a little bit out of that US dollar. That could be a push for, maybe you might add $1 or $1.50 to oil. We'll just have to wait and see on that. But at the present time, I think that that's where the market is.
If I may just
add, please.
Yeah, I think it's also worth noting that we come out of a situation where we for months had a very, very elevated speculative short position in the dollar. There's been a strong belief that we should be going weaker. That obviously did not materialize. We saw the dollar strengthen since the November vaccine rollouts and the presidential election in the US. But since then, just looking at just from the futures market, which is obviously a smaller part of the overall FX market, but we've seen the net short now collapse by 85%. it's now down to the lowest level in 11 months. So clearly investors are much more lean, and they've got much more leaner books now. So if there are any news now which are potentially dollar negative, their response will be greater than it was just a few months ago, because position has been trimmed so much as it has.
Let's go to the room and give everybody a chance to comment on some of these themes, the outlook. What will have the biggest impact on giving markets a new direction? Q1 equity results, which are starting to drip in this week, will they be to the scale that everybody, some are forecasting, and so give an upward momentum? 2 OPEC signals for the next meeting, as Ole mentioned, report out of OPEC today. If they start to signal where the market, where there might go with supply, or 3, COVID-19 versus vaccines, that struggle, will one dominate the other? We've got 1.5 million infections, or not 1.5 million, 150,000 infections in India today, and 1 million Indians meeting on the banks of the Ganges River for a festival. So there's clearly going to be some challenges in India over the coming weeks. How that impacts their continued recovery from the pandemic, we'll have to see, but it looks like they're going to be going into a very difficult period. Paul, looking forward to the rest of the week here, where do you see some of the sort of guidance for the markets coming in? Are we still seeing an inflow from financial investors rather than just the paper traders?
Yeah, just on the survey question, it was an interesting one. In the, I initially went to vote for like OPEC because that's what everyone looks for, but I think we've got a situation now where OPEC will more take the guidance from what's happening with like vaccine and COVID, which then feeds into the demand. So we'll see more and more caution for, well, actually, to be fair, OPEC have been very cautious, since like the agreement, was it last April? So yeah, it will be a very, very, caution will be the watchword for OPEC. I don't think we'll see anything dramatic until there's clear signs.
Ole, on that point of OPEC, I mean, in some ways, the more OPEC increases, it could be the more prices could rise, because then you end up with fewer and fewer idle capacity on the sidelines. It's sort of like a catch-22 once you start moving forward. Your thoughts on that?
Well, that's true, but I think that's first one that will really have an impact later on. But I think you're still right that that by signaling an increase in production, they're also trying to signal some optimism, basically saying that they're seeing the demand for the crude oil over the coming months, because obviously the last thing they want to do is hit themselves in the shoe and see the market turn around again. So I think it will eventually play out, but then as higher prices go higher, then we will also see a response from U.S. shale oil producers. Obviously not at the same pace as we've seen in the past, but it's a catch-22, as you say, Sean, because they want to signal that we are seeing a return to more robust demand. But at the same time, obviously, the facts on the ground has to stack up. And I completely agree with Paul with the survey. I was actually in this complete same mindset. But I think also OPEC right now, they're more not leading the market, but just observing and taking stock of what's happening in the market. And this on the speculative, you mentioned also. We've seen a 15% reduction in the speculative length in WTI and Brent now since January. And I think from the bullish perspective, it's worth noting that most of the reduction has been longs just taking stepping to the sideline. We have not really seen any major build in short positions. So there's not really a strong belief in the market that we will go much lower at this stage.
Actually, sorry, Sean, just one more point I was going to say on the US worth noting. Yeah. Refinery utilization, 84% back to pre-pandemic levels.
Yeah.
So obviously a lot of that has been absorbed. So it feeds into like these figures. So going forward, I think US stats, right, we'll watch those anyway, but there's going to be even more attention going forward if that trend continues.
Let's get the results of the survey. Give Peter the last word here today. COVID-19 versus vaccines is still the gateway, if you like, to the future direction. One wins over the other. In Asia, that would not appear to be a challenge, Peter.
Well, that's exactly right, Sean. And I think that there's, when you think about it, the equity markets may be the draw card as far as Asia. That's been a very strong move. Japan's been quite surprising, I think, over the last matter of months. Certainly, China is now starting to get a little bit of, wind in their sails. And the overall mood is that Asia, from the lens that I look through and where we're positioned, it's a fairly good sign. I mean, we talk to people in Singapore, Malaysia, certainly Thailand and across Indonesia, and there seems to be a resurgence there. The economies are ticking up. The general mood across the countries is fairly strong. So I think that will be a drawing force, and maybe that's going to be the push forward. Hopefully Australia can be, dovetail into that good news sentiment. So that's where we're sitting from the Asia Pac.
Peter, on the point of OPEC plus in sort of their next direction, if you like, are they under a time pressure, you think, to increase looking over their shoulders at shale and others, or can they hold the line for longer?
Well, I think they can hold the line for longer, Sean. I feel as though that, from a demand destruction standpoint, let's get through where India plays and with these growing numbers, and Brazil and across Europe, of course. So that's where I think OPEC have got, that's what their lens is and what they're looking at very, very closely. So we've just got to get through the next quarter. And then where are we come July? Because if things gallop and become far worse from a COVID perspective, then we've got a different argument altogether this time next month, Sean.
Ole, on that, just closing out of that point, that we have to get through this quarter. I mean, the markets are already trading nearly into the third quarter now.
Yes, they are. But the market still, even though that's into the next, they're still obviously responding to what's happening
on the front month.
On the front, exactly. So I think there is obviously a risk. We saw Morgan Stanley yesterday as one of the bigger banks downgrading their forecast, and we could potentially see a few more follow because we're continuing to backload the expected demand growth into an increasing shorter period of time as day goes by, and we go from 1 month to the next. So we could potentially see some additional downgrades in terms of price, and that may just prolong the period that we're stuck in this relatively quiet range here.
Well, I do think we are getting into that window where this European summer travel season nearly is closing from the point of view of holidays in the sun, so to speak, where that and all of the sort of vaccine regulations, they seem to be becoming stiffer rather than loosening. And so maybe that's one area where you will start to be guided by the recovery being pushed out to the fourth quarter, besides the US and China. But let's watch that space. Thank you very much, Ole, checking in from Denmark, Peter from Australia, Paul from Dubai. Thank you all. Have a great day. We'll catch up to you in the coming days. Thank you, everybody. All the best.
Thank you.
Thanks, Sean. See you guys.
Cheers.